Hey Quinn, good
How
good to
are
see
you?
you.
You too.
Doing well, doing well. So yeah, Quinn, you are the head of global expansion strategy for Studio within Tishman Speyer. You've been doing this since the first studio location, right? You've been here since the beginning.
That's
So
correct.
so one of the things that and Tishman I think is widely known, or at least I think, for a investor owner, you've gone first with building your own brand and doing it at the scale that you have. You're not the only one that's done it. You've just done it longer and done more of it. Um, so you have a great point of view at this question, which is what really are the key drivers for Tishman to build its own brand as opposed to just leasing space to operators or doing something else in Flex? Why has it evolved this way?
Yeah, absolutely. So the evolution of Studio has largely been driven by our customers. We found that when we were around the time when we started Studio, we heard from our existing customers as well as customers that we were in leasing conversations with that they would like some more flexibility in their real estate options, right? So looking for turnkey space on a bit of a shorter term, maybe managed for them, as well as conferencing optionality within the property, and generally looking to help solve this issue of headcount volatility. And as more economic uncertainty kind of reared its head and planning cycle shortened a little bit, they looked to us to kind of help solve those problems. So as like a vertically integrated operator of real estate, we thought that the best way to be a partner for our customers was to build it out ourselves and really give them, a Tishman Speyer experience across the entire real estate spectrum. So we went on this journey and it's been quite successful. And, we feel very lucky that we've been able to expand as much as we have and, reach the success that we have today.
So I think in this market where expansion is harder, right, for a variety of reasons that you and I have
Mhm.
talked about, and Nate and I have talked about, what's driving the expansion? I mean, you're always looking at new opportunities, but where your investors and the powers that be within Tishman are saying yes, why are they saying yes? What are they looking for, even in this environment of kind of slower growth in the industry?
Yeah, absolutely. And I think that what I'll describe is might be specific to how we operate Studio. And again, we think about this as the owner operator model where Studio is very much integrated into the entire property. It's not, a third party. The same folks that are leasing the property traditionally are on the same team as those who are leasing the flex space. And we examine expansion opportunities in three broad categories. The first is really the asset strategy. So, how can Studio slot in and help enhance value and existing relationships within the property? The second is the flex market strategy, right? It still needs to be profitable on its own. So, we evaluate the existing landscape, the supply and demand dynamics, how Studio can fit in within those dynamics to maintain healthy occupancy and pricing. Then also the underlying demographic trends and whether they do or do not indicate that the segment of the market that Studio operates will be, successful and growing in the future. And the last bit is the operations and design of the space, and that's really assessing the best layout, again, the best design elements to help sell the space, and really making sure that we can kind of come in on day one and deliver an outstanding hospitality experience for our customers, and then of course sell and market the space appropriately.
Nice. So, you use the word journey, right? And you joined Tishman before Studio, I think, was really even a thing. So what surprised you the most? And I'll tee it up a little bit. You've seen the product evolve a little bit. You've probably seen the customer evolve a little bit. You
Right.
started in Rock Center, and now it's all over on multiple continents. So what are some of the surprises that you've run into in the journey that has been Studio for you?
Yeah, so it's certainly been a journey. It's been a fun journey. Probably whenever I think of surprises, the example that comes to mind is, we've continued to evolve the brand, as you said, as we've learned more about our customers and what they want and, what their desires are and how those are evolving, right? So what started as just co-working has now changed into three different business lines, right? We have the co-working space, which we call Studio. We have the large scale events business, which we call Studio Gather. And then we have our move-in ready suites business, which we call Studio Private. And when we were creating the latter two, having already created the co-working brand, we thought that we could use most of the learnings from the co-working sphere and just rinse and repeat kind of to create those three. But in reality, we've actually had to create distinct teams and dedicate distinct resources to these different business lines and really develop expertise and understand how the customer changes and how to sell these different products and how to operate them very differently. And that's definitely been a learning experience. But what's great is that we're confident that each of these are, really deeply penetrating those markets and providing a great experience for the customers who are interacting with those businesses.
How does Tishman, like, how do you name when you say product lines? What are the three, just so folks can understand the bits of the business?
Right, right. So the co-working business we call Studio, and then the events business we call
Yeah,
Studio Gather, and then the move-in ready suites business we call Studio Private.
cool. Thanks for that. That makes a lot of sense. So let's talk about challenges too. I mean, one of the things that a lot of people talk about that's kind of stereotypically for owner operators is the investment in hospitality is a different deal.
Mhm.
I mean, you're using words like brand, which is not something that most investor owners would talk about, but every operator talks about. So what challenges have you run into as you've kind of evolved these and built these new competencies or new products or whatever? What's been the hardest stuff?
Yeah, you might be reading my mind a little bit, Ben, because you're stealing the answers right from my mouth. But one of the most difficult parts of running this business is explaining market segmentation to our customers. Because as a premium operator, we really focus on building a product suited for enterprise companies, right? And not only for them to use the space for spillover space or swing space, but really as like a longer term solution. And explaining to them how the owner operator model really provides the stability to allow for this to be a longer term solution and helping them understand where Studio fits within the broader Flex ecosystem. It can be a challenge sometimes, but again, we found that once folks are in the space, they have great feedback about the operations, about the sales experience, and we've seen a lot of cross-market deals, right? Someone starts in San Francisco, but then they'll talk to their team in New York, and we'll get some additional business with the same customer across markets, which we find quite validating.
Nice. So one of so Scott Homa, who's head of property research at JLL, he's on the team that coined the 30% of office real estate will be flexible by 2030. And so
Mhm.
I checked in with him. He wrote that in 2017, 2018, and we're halfway there. And one of the things he said and shared recently with Nate and I, among others at ULI, was his early estimate is that co-working of the type that Studio provides, he's kind of reduced his estimate of the percentage of flex that would be. He's increased his estimate of spec suites or Studio Private, what that would be. He's increased his amenity space estimate and increased his kind of call it second gen or sublease space as a percentage. So his conclusion is that essentially it'll still be 30% by 2030, but the mix of it will be different. So how does that, how does that landscape relate to your experience at Studio and some of the things that you're building for?
I don't have many notes about that statement, to be honest with you. Broadly, our thesis is that enterprise demand will drive the industry forward, right? Both
Right.
in terms of capital markets, in terms of the mix of product that you see in expansion. And I would generally agree with him that, these like private suites that are pre-built and, ready to operate for a business on day one, wired, serviced, provide tech infrastructure like internet and that kind of things. We really see a lot of demand and growth in that business. And again, co-working is still growing at a steady clip, but one of the reasons why we built our move-in ready suites business was because we saw the co-working as kind of like a gateway into our portfolio, right? For smaller customers who otherwise wouldn't be able to take down larger space at their current stage of growth. But this really is like an incubation pipeline type thing for the product, or for the portfolio rather. And we've seen a lot of folks graduating from co-working into this move-in ready suites program. We've seen a lot of folks at the stage where they already want the move-in ready suites, and that demand growing at a larger clip than the co-working is as well.
Yeah, makes sense. So with the experience you've got, one of the skill sets that I think you have in particular and Nate has is how to position flexible workspace to add value to big institutional investors, right? You've probably gotten, with the diversity of product and the longevity you have, you've probably gotten really good at telling that story. So what would you share with other owners, not giving any competitive information away, but what would you share with other owners about how they should think about flexible workspace?
Great question. And there are limitations to what I can say here, but I will elaborate on the owner operator model to answer this question, because I really think that having an in-house flex provider enriches the value of the property and helps drive that value in the future, right? Because not only is studio profitable within the four walls, and is additive like to the income of the entire property, we've seen retention benefits, we've seen leasing velocity benefits, and generally we see other customers in the stack, like longer term traditional customers, using studio for a variety of needs. Spillover space, they have a consultants in town, they need conferencing. It just seems like the real estate model is kind of shifting to a lot of typical workspace needs are being provided by the landlord. You talked about amenities earlier, conferencing, all those kind of things. We're kind of like flipping the model on its head from this is what we have, like what do you need, versus what do you need, and like let's create that for you.
Yeah, makes sense. So going back to your day-to-day, which is, expansion, you've continued to add new locations even when interest rates are challenging. High construction costs are definitely here to stay, and with a lot of sublease space on the market. So how have these things really impacted your growth and growth trajectory?
So it's no surprise that the last few years have been tough for the office market more broadly. But what we've found being in the flex space is that a lot of these issues are also affecting our customers. Cost of capital increasing, inflation more generally, and that it makes turnkey options more attractive. So this is an industry where a customer or a company can come in and occupy a space without as much upfront capital. They can occupy that space faster. They can outsource some of the operating expenses to us and really take advantage of our supply chain and our scale. So we found a net effect that includes a positive aspect as well. As it relates to the sublease question, I see it as just another part of market segmentation, and it's really incumbent upon us as the operator to explain the variety of options in front of a particular customer, right? You can take the sublease space, you can take a higher quality space that's serviced and ready to go on day one and has concierge services, internet, and the whole kit and caboodle. And again, it does add to competition in certain respects, but at the same time, it is a different part of the market that we just have to be very aware of and monitor.
Yeah, makes sense. So you've most of what the space you have has been built out to your spec, and we talked about how that spec has evolved over time. But talk about the difference between building out a new location versus taking over somebody else's that might be in your portfolio. What are the benefits? What are the challenges having done that?
Yeah, absolutely. So being a partner with Tishman Speyer and a Tishman Speyer brand, it really gives us optionality in the way that we can expand. We've built spaces from a white box condition. We've taken over locations within Tishman Speyer's portfolio that have been vacated by another flex operator. We've continued to operate studio in buildings that we've sold, and more generally, we're always working with our acquisitions and developments teams to understand how a studio can again fit into that asset strategy and help drive value at all of our properties, both existing and ones in the pipeline. Um, and all of these are kind of their own unique opportunity or unique beast, if you will. And they vary in capex requirements, income projections, operational plans, sales and marketing. So as it relates specifically to the takeover versus, building from white box, there's obviously differences in capital. And when we think about income projections, right, we weren't the ones who originally laid out the space, so kind of have to work with what we've got there. But not all opportunities are the same, and we really have to take a very unique and specific view to every time we open up an Excel model and speak with our teams about the best way that particular location can fit into the broader asset strategy.
Yeah. Any, have you found any specific ways that you might evaluate something that's kind of has been a stronger determinant of success for flex in an asset? Any one or two things that have kind of surprised you?
So like as it relates to like the existing like customer base or like the existing space we're gonna be taking over, can you be a
It
bit more specific?
it it could be anything. I mean, because I've run marketplaces in the past, I
Mhm.
get to see in the rear view which industries go in, which industries will stay the longest, what's appropriate for flex and what's not. There may be some things that you've kind of found in your modeling that you're like, what, that's, and again, I don't want you to give any secret sauce of, what makes for a good flex location in your mind.
Yeah, absolutely. And what's interesting about this is a kind of a question we get a lot where we'll be presented with a market that has kind of poor real estate fundamentals generally, office real estate fundamentals more generally. And they ask, well, can flexible office fit in here and like be the white knight? And most times the traditional market is moving in the general direction of flex. There is some counter cyclical nature to it, of course, but a lot of the same positive indicators of a office acquisition more broadly will trickle down into the flex space. I think some of the things that won't surprise you are a lot of growing companies that need, a 10 desk office, and then in 6 months they need a 15 desk office, and then in a year they'll need their own private space, are in the tech industry. And one of the things we really look at is like venture funding in a particular market. A lot of existing large tech companies, because a lot of times you'll see them be the first movers to the market and like other types of companies following those. But again, that's just one of many um, indicators that we've seen to show that flex will be more of a longer term play there, right? Because obviously you need some time for that investment to pay off, and that's one of the big indicators we look at.
Nice. It makes sense.